What if I told you there's an asset class that's sitting at over 20-year lows relative to the stock market, that it offers the potential for protection against runaway inflation that we believe is likely coming, and most investors are significantly underweight or completely ignoring it in their portfolios? I'm John Llodra from New Harbor Financial, and while everybody's been chasing AI stocks and crypto, smart money has been quietly positioning in something far more fundamental: the physical resources that power our civilization itself. The last 15 plus years has seen some dramatic things both on monetary policy front and fiscal front. In the wake of the great financial crisis, our Federal Reserve and the central banks across the world flooded the system with trillions of dollars of money literally printed out of thin air. And governments here in the US and abroad are spending like there's no tomorrow. Yet the physical materials that build our roads, power our grids, and feed our population have all been ignored by Wall Street. And you certainly can't print them with a computer keystroke. And of course, we've talked on our channel here a lot about precious metals and their importance in creating the basis of sound money and taking back of some of the renegade policies in both in the monetary and fiscal front. But I'm talking more about the broader set of commodities that literally go into everyday materials, whether we eat them, we drive on them, live in them, or whatnot. We often talk about commodity super cycles, and if you miss this commodity super cycle that we think we're in the early stages of, you may be watching from the sidelines as inflation affects everything from your purchasing power to your level of comfort, while commodity investors potentially will see very important uncorrelated returns for the many years to come. I do believe that we're going to be about to witness one of the greatest transfers in wealth in history. We've seen policies like quantitative easing and other extreme monetary and fiscal policies. Those policies up until a little more than a decade ago were never before seen. Now these policies are like the genie out of the bottle, and I have no doubt that when the time comes again to kind of kick the can down the road, that our governments and central banks will do more of the same, but probably this time on even greater level of steroids. So we do think that commodities are going to be a really important place to be. In the next 15, 20 minutes, I'm going to show you exactly why commodities could have their moment, and importantly, how to invest in them, and what are some of the costly mistakes that hurt investors who try to play in this space. This isn't theory. It's about positioning yourself for what we think is going to be an increasingly important part of your portfolio allocation in the years ahead. Let's dive right in. So in the lead in, I talked about how commodities are undervalued relative to the stock market. And this is a chart that's meant to picture that. This shows a ratio of the Bloomberg Commodity Index relative to the S&P 500 index. And what you can see is this ratio has steadily declined. It rose and then has steadily declined since about 2009. And we're at levels now we haven't seen in over 30 years. Taking even a longer view, this is a chart that was put together by a firm that we like a lot, Gearing and Rosenzweig, and this chart goes back to 1900, and they show it as essentially the same kind of ratio, but a ratio relative to the Dow Jones Industrial Average, which goes back much longer in history than the S&P 500. And you can see we're at one of the points in history that they estimate to be literally one of the most undervalued relative to the stock market in history. So very, very extreme reading, no matter how you slice it from a historical standpoint. This is all while investors have more or less become very underweight this sector. This is a chart put together by Bank of America in their Global Fund Manager Survey. This is late 2024, but it showed that the fund managers had a allocation to commodities 7-year low versus the history. Now, since that time, there has been a subtle but important increase in commodity allocations, but we still think the allocation to this space, certainly by professional investors, but especially by retail investors, is dramatically lower than what it likely should be given what we see coming down the pike. So one of the long-held reasons for owning commodities is that they can provide a potential hedge against inflation. Now, inflation, of course, is the cost of living going up and the purchasing power of the dollar and other fiat currencies going down. They are two sides of the same coin. This is a chart that goes back to the mid-1940s, and it shows the U.S. Consumer Price Index, one of the common measures of inflation, steadily rising over that period of time. It's risen nearly 1,400% cumulative over that period of time. Now, of course, that's not the whole part of the story, because it's what does that inflation mean for the purchasing power of the US dollar? And what you see here is the percent change in the purchasing power of the dollar over that time frame has reduced by over 93%. So what a dollar could have purchased back in the mid-40s can only purchase 7 cents worth of goods and services today. This is dramatic erosion of purchasing power, and one of the main reasons people think about commodities. And there's actual empirical research that suggests that commodities can be a very, very important portfolio tool to hedge inflation. So this is a study that was looking back over 1872 to 2023. And it looked at different inflationary environments, inflation below 0%, between 0 and 2%, between 2 and 4%, between 4 and 6%, and greater than 6%. And what you see here is that especially in the scenarios, the blue bars where inflation is running quite hot, commodities have been unparalleled in terms of the annualized return, 10-year annualized return in those environments. Now, commodities aren't always the right place to be, as you can see here, during low inflation or even deflation scenarios. They actually perform quite poorly relative to other assets. So there is no silver bullet here, excuse the pun, but commodities can be a tremendously important, especially in the right dosages, diversifier for one's portfolio to hedge inflation. And this phenomena is on full display if we, for example, go back and look at the returns of different asset classes during the hyperinflationary 1970s. What you see here is we've got returns for various types of assets, both in a nominal as well as an inflation-adjusted basis. And what you see here is, for example, if you look at S&P 500, the stock market, and 10-year treasuries, what we might call the bond market, while each of those delivered very, very low and modest returns for the decade of the 70s on a nominal basis, they both lost value on a real basis, an inflation-adjusted basis. What did well? Things like commodities, various metals, agricultural commodities, energy commodities, gold, silver, Brent crude oil. So very vivid example of how commodities did quite well relative to more traditional financial assets during the 70s. Even more recently, in 2022, we saw both stocks and bonds drop considerably. If you look at the correlation between commodities over the period 2000 to 2024, what we see here is that commodities have a very low correlation, about a 0.2% correlation to stocks, the S&P 500, and actually a slightly negative correlation relative to the bond market. What this means, when you have uncorrelated or lightly correlated assets, they tend to offset when those other assets are not doing well. So what you don't want are assets that are highly correlated to one another. And commodities have, certainly in recent history and longer history, presented a very compelling low or negative correlation asset to more traditional financial assets. As you might expect, when we're dealing with real things, real commodities, it's not as simple as hitting a keystroke like central banks can with printing money. In fact, there's a very long lead time of capital expenditure, production, development of new mines to get these natural resources out of the earth. And these things don't happen overnight. There has been a long observed cycles in the commodity markets. We like to call them commodity super cycles. These are affected by a whole host of things, including supply and demand fundamentals, investor flocking into or away from these assets. So this is a graphic that was put together by the visual capitalists, and it draws upon some really important statistical research that the Bank of Canada has done as relates to commodity cycles. You can see things like overproduction, war, shortages, and other factors affect the supply and demand of these commodities. But also, beyond these events, longer-term patterns occur with the price movements of these commodities. So what we see here is a representation of the price movements of different components of the commodity markets. You've got oil, base metals, livestock, agriculture. They often has moved not quite lockstep, but they have enough overlap that it tends to trace out a broader commodity cycle. And that's what the right-hand side of this chart shows. And this is updated through 2016. But you can see there was a first super cycle. And what we define cycles here, we talk about the full completion, rising and falling above and below the median line. So you see this first cycle in 1899 to 1932. You had a period here of about 33 years. The next one was 33 to 61, right here. And then the next one from there was 1962 to 95. And then there was one that started in 1996. And at least as of this chart in 2016, it had started to revert down. In fact, the last several years have seen this cycle actually drop below that median line. You might say, and we are probably on the verge of a brand new super cycle swing higher from these recent years of rather anemic price movements in most of the commodity complex. We've seen a dramatic pickup in things like precious metals in recent months and years, but things like energy and some of the base metals have not followed suit in the same way. So getting back to the supply and demand fundamentals, this is on the left-hand side of the chart is a depiction of capital expenditures for new production of different types of natural resources. And you saw there was a massive ramp up in 2011, 2012, and then a dearth of expenditure here in the belly of the 2010s, and then trailing off again here in the 2020s. So there's been a chronic underinvestment in these types of commodities, all while the demand for many of these commodities has been off the charts. We've seen renewed interest in infrastructure spending to rebuild bridges and roads. We have seen a massive expansion in renewable energy and electric vehicles, as well as expenditures on computer equipment, AI computer servers, all of which require massive amounts of various commodities. So one of the challenges has been that the extractability of these resources, being a finite natural resource, has gotten more and more difficult and expensive. And this graphic on the right speaks to that. This shows major copper discoveries since 1900. And what you see here is a trend over time that these mines have become less and less, but they've actually had to go deeper and deeper into the Earth's crust to kind of get to the deposits. And those deposits tend to be more dispersed, harder to mine the materials. There's some great photos, vintage photos from the early days of copper mining, for example, where they show miners standing on massive, huge boulders, if you will, of copper ore. Now it's very dispersed through the soil and much harder, more expensive, you might say, to extract. So the supply and demand dynamic is we think, a major tailwind. The supply is going to, we think, be increasingly constrained, more expensive to extract, fighting for capital dollars from other industries. At the same time, that demand for these resources, especially empowering the grid and the proliferation of new technologies that require more robust and more complicated grid components, the demand, we think, is likely to keep on going. And again, things like infrastructure spending are certainly going to create continued demand in the face of these scarce supplies. So we think that will likely translate into higher prices ahead. When you layer on top of that the merging tensions in the world, you might say the de-globalization, the re-onshoring that we've talked about much of this year with President Trump's policies in relation to tariffs and bringing jobs and production back here. We're talking about unwinding decades worth of globalization and supply chain dislocation. And we think the bottom line takeaway from that is there are going to be constraints and bottlenecks and disruptions that are going to cause periodic sustained price spikes in these very important commodities. So I want to talk quickly about investing in commodities versus commodity stocks. So it's one thing to invest in copper itself, for example, or invest in BHP, which is a big Australian domiciled mining company that does a lot of copper mining, for example. Commodities give you direct access to the commodity, as you might imagine. Investing in commodity stocks tends to be a bit more tricky because they oftentimes have volatility that is more aligned with the stock market and what's going on in the economy than the pure commodity markets. Layer on top of that the reality that individual companies, mining companies, have all kinds of operational, geopolitical, and management risks that can cause those stocks to have challenges even while the commodity markets themselves stay robust and prices are going higher. What we're talking about here is direct access to commodity materials, not the resource stocks themselves. So with that in mind, I want to talk about how to actually invest in commodities, because it's not quite that easy. In fact, it's easier than it's ever been. But if you go back in history, the only real way to invest directly in commodities is by directly investing in commodities future contracts. These are not for most retail investors. Unless you're a professional trader with deep expertise in futures contract specifications, margin requirements, rollover dates, things like that, stay away. They're complex. They require active management and can literally blow you up if you're not careful. Instead, we want to focus on the proliferation of many very efficient ways to invest in commodities, especially in the exchange traded fund or ETF space. For most investors, ETFs are going to be hands down the way to go because they give you access to the space without the complexity of having to invest in individual futures. But there are really important nuances and caveats because all commodity funds are not created equal. And there are some very important details I'd like to cover to help you be more informed as to where might be the best place to put your funds in the commodity space. The first thing I want to point out is that investing in commodities, whether you're doing it in futures or in some funds, they oftentimes can generate a tax headache. And what I mean by that, depending on the structure of the fund, they can generate what's called a K1 tax form. Now, K1 tax form is a tax form that investors in private partnerships or private companies will oftentimes get. So, for example, as a part owner of our company here, New Harbor Financial Group, every year when we do our corporate and my personal taxes, I get issued a K1 to represent my tax impacts of owning shares of New Harbor Financial Group. Many of the, especially the early launched commodity ETF funds, issue these K1 forms. Now, they're not in and of themselves a problem, but they become a major headache because they oftentimes don't get issued until very, very late in the tax cycle, near the deadlines of the April 15th filing, sometimes even beyond that. Most folks want to get their tax paperwork done and off their minds and off their chests well before the April 15th deadline. So for that reason alone, many times you want to avoid K1 funds. There are other funds that do this by investing in a different structure that the trade-off is they issue 1099s every year, just like any other investment vehicle. You look for a commodity ETF, check if it issues a K1 or a 1099. My strong advice, unless you have a compelling reason to want to wait for a K1 or there's something specific about the fund, I would stick to the ones that issue 1099s instead. Much simpler from a tax standpoint. The next thing I want to cover is what we call roll yield. And this is something that can be help or a significant hindrance to your investing in commodities. Specifically, I want to talk about two conditions that will hold in futures markets. One is called backwardation and one is called contango. The reality is that when you invest in futures, whether directly in futures or in one of these ETFs that invest directly in futures, there is what's called the term structure of the futures curve. Sometimes it's backwardated, where if you look at contract maturity along this axis and price along this axis, the near dated contracts are higher priced than the outer dated contracts. That's what's called backwardation. Now, why might that happen? It might happen if in the near term, for example, there are supply disruptions. Let's say a major refinery blows up and it's going to take many months for that refinery to come back online, or there's tensions in the Middle East that presently are causing oil prices to spike, but the belief is that over time those will resolve themselves. Those are examples of what can cause backwardation. Contango, on the other hand, is where future dated, longer dated into the future, the prices are higher than where they are today. And that simply can reflect a pretty normal scenario where increasing demand relative to a limited natural resource supply creates constant upward price pressure as you get later, more distant into the future. Now, the reason this matters in investing in these kinds of vehicles is that by definition, anytime a fund owns a futures contract, that futures contract expires every month, and it automatically has to be rolled out to a later dated contract to maintain the exposure. So, for example, in a backward-dated market, this fund might be forced to sell a contract here, but buy one here. And that's actually a benefit because they're selling high, buying low, so to speak. But in a contango market, the opposite is the case. This fund might have to sell a contract that's expiring here and roll into a new one here at a higher price. That systematic rolling, especially in a contango market, results in a leakage, an ever-present loss to these higher roll yields. So that's something to be very cognizant of. Now, thankfully, many funds have adopted strategies and methodologies that are very sound and very experienced as relates to futures contract trading to mitigate to the best degree possible the impacts, or at least the negative impacts, of those roll yields. So they might solve that by, for example, instead of investing in just one prompt month contract, they might spread it out over several months so that only one piece of the portfolio is coming due to any given point in time. There's a whole myriad of strategies that different funds use. All to say is seek out those that are smart about and have a system, a disciplined system for managing this concept of roll yield, especially negative roll yield. The next thing I want to sensitize viewers to is that there is more than one commodity index, and index construction matters. Not all indices, commodity indices, are created the same. Here's a chart that was put together by Granite Shares, and it's a little dated. This is as of September 2020, and certainly the weights have shifted a bit since then. It does a very good job showing the relative differences between two I'd say the most common commodity index, the S&P GSCI commodity index and the Bloomberg commodity index. What you see here in broad categories, for example, the GSCI had a full 63.4% in energy weightings in the commodity basket, whereas the Bloomberg only had just under 33%. Grains, like agricultural grains, 11.5 for GSCI, 20.5 for Bloomberg. Precious metals, an area that we've talked about a lot, GSCI has only had 4.2% versus 15.3%. So depending on the dynamics of each of these indices and the trends and the momentum, the results of these indices can be very, very different. We actually favor funds that have a trend following or some other smart, quote unquote, smart allocation other than a static allocation to these various baskets. For example, we've used a commodity ETF in the last several months for our clients that has a very dynamic approach, and they have been dynamically overweighting, for example, precious metals, which have done very, very well relative to the broader commodity basket. And they've underweighted things like energy, which has struggled even despite the recent shoot higher and relaxation of that spike in recent weeks. So the index construction really matters, and we encourage folks to pursue those funds that have a systematic trend following or other disciplined approach for tactically and dynamically weighting across the various commodity exposures. Now, before we wrap up, I want to touch upon emerging considerations. There are a whole host of other commodities that, are really central to a lot of emerging technologies and trends. So, for example, we can talk about uranium and the understandably renewed interest in the nuclear sector, innovation in nuclear power, different types of technologies that are easier to permit, safer, maybe don't have the same waste as traditional old school nuclear technologies. Well, certainly there are ways to invest directly in uranium. And there have been times where we've owned investments that track uranium and other nuclear types of technologies. Talk about renewable energy and other alternative energy methods and other kind of electronic innovations. These things tend to require what we call rare earth materials, metals, which are even scarcer than some of the commodities that we talk about in mainstream. These kind of niche commodities are in some ways really, really critically important to emerging technologies, but they're also can be very volatile because they're, by definition, maybe scarcer, more concentrated in countries or hands of few developers or miners. All to say is that these can be very important places to invest, but they can shift really rapidly and they can be very volatile, even more volatile than the broader commodity complex. So if you're going to invest in kind of these more niche commodity themes, we really recommend you take a go small approach. Don't overweight. Don't put a whole bunch into any one of these areas. Just a sprinkling of these around a broader commodity strategy, we think can be very effective, and you don't have to put all your eggs in one basket and shoot big just to have that positive impact of those exposures. So I want to wrap up with a couple key takeaways. Commodities are dramatically undervalued relative to financial assets. We saw that in the very first charts that I shared here. Now, part of this is because many financial assets are more extremely overvalued than they ever have been in history, but we think there's a middle ground there. We do think that the pricing in commodity assets, for all the reasons we talked about here, are likely going to tighten up and firm up and rise over time in history. For most investors, as we said earlier, ETFs are going to be the best way to get access to the commodity exposure. Don't go into futures yourselves. You certainly can if you're motivated, but there are a whole host of other complications and dynamics you want to be mindful of. Start with broad-based, diversified commodity exposure through the funds that issue 1099s rather than K1s. There's a bunch out there that have reasonable expense ratios. If you're comfortable, you can add target exposure to some of these more niche sectors like the rare earths or the specific materials that are powering our AI and renewable energy revolutions, if you will. We do think we're likely in the early innings of a commodity super cycle that will last 10, 20 years if history's any guide. We don't think it's a question of whether you should have commodity exposure, it's whether you position yourself before it's too late. There's timing in everything, and you don't need to be perfect. And nothing here is a guarantee that commodity prices go up. But if you look at the big picture here, we think the odds are certainly favorable for that. But even without the absolute performance, the diversifying effect of a commodity exposure in a traditional stock and bond portfolio is irrefutable. So I hope you found this video helpful. We invite your questions. Give our office a call anytime. We're happy to answer any questions you have, whether you're a client or not. Please feel free to share this info video with your friends and family if they might find it helpful. I invite you to like and subscribe to this channel. Hit the little bell icon to be reminded of the content we put out nearly every week. And of course, if you want to click below in the bio here, you can click on a link to get a free consultation with our team here at New Harbor Financial Group. We can cover commodities, of course, but we can cover the broader spectrum of financial matters that we work on every day for our clients. I want to thank you for watching, and until I see you in the next video, have a great day.